All right, second to last class, we're going to talk options today. Real quick, I want to cover the put call parity we didn't get to finish last time, and then we'll get into these calls, puts, and then common strategies. Get you ready for the exam, but also get you ready for just understanding how these things work. They're very powerful tools. All right, so we're going to talk about calls and puts today using this formula, a very simple formula. And then we'll look at other combinations where we combine them. But this brings up this concept of put call parity. And you'll definitely see it today when we talk about these different strategies. But put call parity is a mathematical truism. It gets a little messy because interest rates, you may not know the exact interest rate to use, or you might have a stock that pays dividends, so it can mess things up a little bit. But essentially, here's the formula. It's a really good formula to just know. A call plus a bond, we'll talk about this bond, equals a put plus a stock. And we're actually going to do some of these strategies so you actually see them. So buying a call option, we're about to do that today. We'll see what a call option looks like, how to value it, how to assess the gains and loss. The present value is the present value of X, which is the strike price. So if you were to have a bond, let's say the call option matures in 3 months and the strike price is $50, then you would have to bond that in 3 months will mature at $50. That's what this present value of the strike means. Plus you buy a put, we'll talk about that, and you own the stocks. So these all equal each other. These two have to equal this. They have to equal each other at expiration. If they have to equal each other at expiration, they have to equal each other today, even before expiration. So we can move this over to the other side, and we say a call equals a put plus a stock minus a bond. But I think even more interesting, let's say you want to buy the stock but you just can't buy it. What you could do is sell a put, buy a call, and buy a bond that has a maturity value of X, the strike price, and you will end up with the exact same return as buying the stock. All right, so there's just different combinations. There's another way they show it. Remember, I use the X. Some people use the K for strike. But so the bond piece can be shown different ways. But it's always call plus bond equals put plus stock. And what that means is, if you were to look at this, I was trying to find you one, but to be able to do this, I have to find a stock that's right at at a strike price. And it's hard to find a stock that's trading for exactly $240 or $150. $150 or something that clean. So I just couldn't find an example to give you. But let's say you found that the left side of this transaction was $50 and the right side was $53. What would you do? Well, you always sell the more expensive one, sell the $50 one, buy the $50 one. So you got $3 left over with no investment, right? You sold this for 53 bucks, you bought this for 50 bucks. They exactly offset each other, plus you got an extra $3. So you have $3 with no investment, and you know at expiration that these two things must equal each other. At expiration, they must equal each other. And if that's the case, then you're getting $3 and there's no risk at the end. It's going to be exactly, these two are going to be exactly equal to each other. And if that's the case, then why not? And how much would you do that? Well, I'd do not $50 and $53, I do $50 trillion and $53 trillion. So if these get really mispriced, then yeah, there's arbitrage, what we call arbitrage opportunities, the ability to make money without investing anything. So you essentially end up with a cash flow of $3 for something that you know will be worth zero in a few months. Yeah, do millions of transactions if you can. Now, obviously, we can't take advantage of these transactions because the cost of the transaction itself will destroy it. But there are hedge funds that can certainly take advantage of these whenever a put or a call or something gets out of whack. They do have to know what their discount rate is in order to make sure they have the right valuation for the present value of the strike. Otherwise, they're just kidding themselves. So that's put call parity. That's the term I would definitely look up in Wikipedia and Investopedia and get some good discussions on that. It's a really powerful part of finance, but we'll definitely see it today. So you're gonna see what I'm talking about. We can get into that. So here's the other strategies we're gonna do. So what we're gonna do first is we're just going to do a simple call option. And so here I have Apple stock in Yahoo Finance. And what I'm going to do is going to come over here to the option. We notice that Apple's trading for 113.85. That's very important to what we're going to do. So I'm going to click on options. When I click on options, all the options for Apple come up. The expiration is November 27th, which is actually going to be expired by the time I do this class. That's because I did this before November 27th. But let's go out to March 21. We got the March 21. We have some call options up here, and down at the bottom we have some put options way down at the bottom. Put options. So we're going to start with a call option. And let's say we do a call option for Apple. Now you can notice we talked about at the money or out of the money or in the money. So this 112.50, that would be out of the money. I'm sorry, in the money, because you have the right to buy it for 112.50 and it's currently trading for 113.85. So that would be in the money. The 115 be out of the money. You have the right to buy it for 115, but it's currently trading for 113.85, so that wouldn't be good. But let's try 120 as our strike. And you'll notice this is the last price, and then there's two options here. There's the bid and the ask. Remember, anytime on the exam I give you both the bid and the ask, but it's really easy. Anytime you're buying something, you will always pay the higher numbers. So that's the 620 is what this option. So to buy this option, it's 620. Now on the exam, we're only going to do one option. Some of you may have done some options, and in practice, you don't buy one option. You have to buy a packet of 100 options. You have an option contract, and that's 100. We're not going to deal with the 100. We're going to do everything as a single option. But in reality, you couldn't buy just one of these for $6.20. You have to buy 100 of them for $620, but we're just going to do one. So let's put that into our model here. So we got Apple is our stock. Its current price is 113.85. So we'll put that in there, 113.85. And we got a call option. Its strike is 120. Its maturity is March 2021. And the premium, so we just saw the premium, is $6.20. All right, so that's all we need to know. And so what we're going to do, and what you have to do on the exam, is take one of these scenarios. We're going to do several scenarios, but let's say Apple stock as far as in March 2021. All right, so this is the scenario we're going to run right here. Let's say Apple's trading for $70. Or what if it's trading for $75? Let's go way down here. Let's say it's trading up to $200. All right, so let's do all these scenarios. That's at expiration. Now we know today Apple's trading for 113.85. So let's do the stock gain or loss. So if you were to buy Apple stock for 113.85, where would you be as of March? Well, the stock gain or loss is going to equal today's price at expiration minus price at initial purchase. So we're going to say we initially purchased it for 113.85. Then we come up to March 2021. So we take the $70 minus what we paid, and that gives us a loss of $43.85. We can copy that down, and you notice once it goes above 113.85, we start making money on this. all the way up to 86 bucks. So there's our payoff. Now let's do the call gain or loss. And remember, I've already shown you that, but we'll do it again. The call gain is going to equal the max. Remember, with the stock, you do the stock price minus the strike versus 0, and then you do minus the call premium, because you had to buy, you had to pay for the call. All right, so very simple formula. So we'll just do that. Equal max the current stock price minus the strike. The strike is 120, comma 0. Now what is that going to give us? Well, 70 minus 120 is negative 150. What's the max between negative 50? Negative 50. So 120 minus 70 is negative 50. So what's the max between negative 50 and 0? Obviously it's 0. And then all we have to do is subtract the call option, 620. So there we have it. And you see at around 130 bucks, it starts making money. And we'll talk about that. Well, here we can see we buy the stock for 120, right? Because we get to execute the option. So in 3 months we can buy Apple stock for 120. So we take 130 minus 120. So we just made $10, but we had to spend $620 to get it, and that's where our gain is $380. So I asked the question, what's the break even on this option? Now you can't say, well, what if it goes up 113 plus the 620? What if it gets up to 120.05? That doesn't work, because remember, your strike is 120 bucks. You don't start making money until it hits 120. So, but when it hits 120, let's say it goes to 121, you've still lost $5.20. Because if it goes to 121, you buy the stock for 120, you turn around and sell it for 121, so you made $1, but it costs you $6.20 to get it. So can you tell that your break even is 120 to strike plus the call premium? So 126.20 should be the break even. If I just plug that in there, you can see that's the break even. So the strike price plus the call premium, it'd be a little different with puts. With the calls, the strike plus price, the stock price plus the call premium is your break even. Now let's graph these two things just so we can see what they look like, because you're going to see a very, very important picture here. I'm going to bring some numbers in. Let's bring in Apple stock price so we can see it. And let's move that down really low on the page so it doesn't get in the way of our graph. And so here is a call option on Apple stock. So here's a call option on Apple stock, and you'll notice the blue is just the stock itself. You buy the stock, you got this line. If you buy the call, you have a max loss of $6.20. That's the worst you can do. But as the stock gets above 126.20, you start, well, as it gets above 120, you start getting some of your option premium back. And then at 126.20, then you start making gains. Now you don't make as much as you would if you bought the stock, but remember, with the stock you had to pay $113.85. With the call, you only paid $6.20, so your percentage return is much higher with the option. Of course, down here you lose 100% of your money, where at the stock you don't lose 100%. But that is how call options look. I think of it as a hockey stick. So hockey stick going up, and it's a bullish strategy because it makes money when the stock makes money. It goes in the same direction. It's bullish on Apple stock. You would buy a call option if you think Apple stock is going up. And so that's the first example. Remember this shape, because we're definitely going to see this hockey stick again, and it's going to be directly related to put call parity. All right, so there's your first one. What do you have to know for the exam? You have to know how to calculate the stock gain or loss, because sometimes you own the stock and sometimes you won't. That's really easy. You just take the stock price at expiration minus your initial purchase price, so that's really easy. And then you have to memorize this formula for the gain on a call. remember this first part of the equation, this part right here, that is the intrinsic value of the stock. So the max S minus X comma 0, that's the intrinsic value of the stock. Remember when we're trying to calculate time value, we take the call option minus this intrinsic value. So here, when we started off on this, what was the time value of this option? It's going to equal the call premium minus the intrinsic value. That is, it's going to equal the call premium minus the max of S minus X comma 0. When we started out at time 0, what did we have? We had the call premium 620 minus 113.85 minus the strike. That's a negative number, so 0. So at initiation, when we bought this call option, the entire premium was time value because this option was out of the money. There's no way we're going to spend $120 to buy a stock we can buy for $113.85. So when a stock's out of the money, all of its time value, all of its option premium is time value. All right, so this formula right here, you need to remember it for more than just these exercises. You also need it to calculate the time value of the stock. All right, so there's the very, very first one. Now let's try another one. Let's do Apple again, just to save me some time, and let's do a so the current stock price we know, so we can keep that. So now what we're going to do is a put option. So let's go back to our Apple, and let's go down to the put options. Here's the put options up here. Now here what we're worried about is Apple falling in price. So these are out of the money down here. Anything below 113.85 is out of the money because that's what we get the right to sell Apple at. And so let's say we're worried about Apple stock price falling. So let's get an option at $100. We'll do a strike at $100. So you see at $100, the premium is $315 and $335. Remember, when we're buying the put option, we pay the higher number. So this is the last price, the bid, and the ask. Because we're buying this option, we have to pay the higher number, $335. All right, so the premium is $3.35. The maturity again is March 2021. And then the strike, I'm doing it slightly different order. I think I did strike, maturity, premium before. It doesn't really matter what order you do. But $100. We're going exactly $100. All right, so now we want to ask the same thing we did before. What's the gain or loss on the stock itself? I'll bring in the same prices over here that we used over there. So let's figure out. Let me clean these up a little bit, and then we'll copy this over. So there's the stock gain. Now we're going to do the put gain or loss. All right, the stock gain is exactly the same thing we did before. What the stock price was at expiration versus what we initially paid for it. So this column will look exactly the same. It's just a diagonal line. And then the put. All right, so the put gain is going to look exactly like the call. It's going to be the max, but instead of S minus X, it's going to be X minus S and 0 minus the put premium. And again, this right here tells you the intrinsic value of the put. This put is out of the money, so we take X minus the stock price, 100 minus 113. That's a negative number, so this is 0. So 100% of this premium is time value. So the time value of this premium, this option is $3.35 because the intrinsic value is 0. So let's put that formula in there. Max of the strike minus the current stock comma 0. Now here we have a gain, right? We have the right to sell this stock for $100 and it's currently only worth $70. So we're going to make $30 just on that, but we had to pay $3.35 to get it. All right. Now what's the break even here? Well, the break even here is going to be your strike minus the premium. So if you do 100 minus 3.35, you'll get exactly break even there. Because once you hit 100, yeah, once it falls down to 100, it goes down to 99. Now you make $1 on the option, but it costs you $3.35. So at 99, you'll lose exactly $2.35. At 98, you have $1.35. At 97, you have 35 cents. At 96.65, you have exactly 0. All right, so that gives you a good sense of how these things work. It's actually pretty simple. And now we're going to look at this graph, and this graph is going to look similar to the call, but just it's going to be upside down or backwards. It's going to be backwards. So let me clean this up, but just look at that. Again, it's a hockey stick, but it's kind of laying on the ground. And this is a bearish strategy because it gains when Apple stock falls, and you lose all your option premium when the stock goes up in value. So let's put some links in here. We'll put the stock price in there. Let me just clean up this a little bit. So we want our labels low. I wish Bill Gates would make that the default. And then our number, we don't really need 2 decimal places on this. So this is an Apple put option. I should have marked this one. Let me select that as, so the blue line is Apple stock, and the orange line is the call option. And then for the put, again, the blue line is Apple stock, and the orange line this time is a put option. Okay, and there's the picture. So that's what a put option looks like. A bearish strategy going to the left, so you start making money at 96.65, you start making money, and then make quite a bit of money. If the stock price goes up, you lose all of this. So this is a bearish strategy. Here you're betting that Apple stock is going to fall. And so there's your strategy there. So what else can we do? So we did a call option. We did a long call option. Long means we bought it. What if you did a short call option? Where a short call option, pretty simple. If you're selling the option, you just take this column, and instead of doing, you just see the opposite of it. There is one difference related to the bid ask that we'll see, but yeah, it's just the exact opposite. So it's going to look kind of like the put, except for it's going to be a small gain here. I'm sorry. It's going to be a small gain here, and then it's going to start going down. Very dangerous strategy, right? Because you have a small gain if the stock falls, but if the stock rises, you start having huge losses. What if you sell the put option? If you sell the put option, it's just going to be minus this. In that case, you're going to have a small gain and then a large loss. So you'll be going the opposite direction. So it could be going down over here. Not that much different than the call, except for just going the opposite direction. So there's our put option. So pretty cool stuff. So what else can we do? Well, the next thing we can do is what we call a protective put. And you'll just have to learn this. You'll just have to know what this means. So a protective put is when you own the stock. So So you're long the stock, you own the stock, and you're long a put option. That's what protected put is. So let's stick with Apple just because. So this was a long put, which is what we're about to do. So I'm going to copy this over and put it. Well, before I do that, let me. No, I'll just copy it over. We'll just have to lose that. And so a protected put is long the stock and long a put option. So we've got everything set up. So, so our current price is $113.85. So the put option premium is still the same because we're buying a put just like we did in the previous example. We bought the put. So here we're buying the put. So we're long the put, so we pay the put premium. Was when you sell an option, that's when you have to use the bid price instead of the ask price. But anytime you buy an option, you use the higher number, the ask price. So in the exam, I gave you both the bid and the ask. All you got to know is when you're buying an option, use the higher number. When you're selling an option, use the lower number. It's really straightforward. So we've already got this set up for Apple. So there's the stock gain or loss. If the stock price falls to 70, we'll make $70 minus initial purchase, or we'll lose $43.85. The put option, remember our strike's 100, is trading for 70, so we made $30 minus the $335, so we made $26.25. So let's do a protective put. So what's a protected put? Well, we own them both. If we own them both, we just do plus. Plus the 43, plus the 26. We can copy that down. And now when we do this one, I can now edit this. Oh, that's strange, really bizarre. It's going back to the other page, so that's what we want there. And this is going to be a protective put. Make sure my Apple stock is good. Nope, it's referring to the wrong cell. That's the problem with copying over. So there's my stock. Now let's just look at this. This is Apple. I'll explain it here in a second. Protective put. Let me get everything lined up first. And I don't know why I can never hit the cap shift. All right. So here's the protected put. If the stock price falls, the most we can lose is $17.20. What is the $17.20? Well, once the stock hits $100, we can no longer lose any money. So if it goes down $100, we've gone from $113.85 down to 100. So on that, we've lost. At the strike price, we've lost $13.85, but we also paid the premium. So the most we can lose is the difference between our purchase price, $113, and the put strike price, so $113.85, and we lose the premium. So that's where that $17.20 goes. But that's the most we can lose. If the stock falls down to 2 cents, we still the most we lose is $17.20. So, but this should look really familiar to you. Doesn't this look like the exact same hockey stick we saw with the call option? Not exactly the same, but very similar hockey stick that we saw. If the stock goes up, we make money, but if it falls, we've got protection. Now think back to put call parity. What did we say? So put call parity says that a call plus the bond equals the stock plus the put. And what did we just do? We just did the stock plus the put. And it looks exactly like, it looks almost identical to the call option. The bond doesn't have much impact because interest rates are so low. So you just proved the put call parity. The call looks a lot like the stock plus the put. So these two strategies are very similar, with the exception of the impact of interest rates. So yeah, that's exactly what I meant by put call parity. It's amazing how similar these two charts look. So there's your protected put. Very common strategy. The next strategy I want to do is a covered call. Before I do that, let's go back and look at what we're doing here. So let's just do the 110 example. Let's say it ends at 110. All right. So you buy the stock and now it's trading at 110. So on the stock, you're going to make 110 minus your purchase price, 113.85, or you're going to lose 3.85. So there's part of your transaction. So the stock ends at 110. If you just bought the stock, you would have lost 385. Now if it's at 110, your strike price is 10, so the put is going to equal the max of your strike minus your stock price, comma 0, minus your premium. So that's going to equal the max of 100 minus 110, comma 0. I'm sorry, your strike 110 minus 100, comma 0. So you make $10 on the option, but you have the option premium 3.35. So how do you do on this particular transaction here? You lose 385, you lose the 3.35. At 110, here's 110, you lose $7.20. You lose $3.85 because the stock fell from 113.85 to 100, and you lose $3.35 because the option expired out of the money. It didn't drop below 100, it only dropped down to 110. All right, so you just got to make sure we bring all these together. So this is just an example, and you can actually see it down here as well. So I'll do an example of that particular one, and you can see I get the same 720. So let's do a covered call. So covered call is going to look a lot like the call, so I'll copy this call one over. So let's look at a covered call and let's see what that is. A covered call is you're long the stock and you're short a call option. You're probably not going to like this strategy, but that's okay. We'll set it up. This is a covered call on Apple stock. We'll set it up. So the same thing as before. Now here it is different. Here the premium, we have to use the bid because we're selling this option. So we want the lower bid number, not the higher ask number. I might have said that. Sometimes I say those backwards, so I hope I didn't mess that up. If I did, you know, just know the bid is the lower number. I always have to think about it. The bid is the lower number, the ask is the higher number. So in this case, we're selling the call option. We're selling a call option at 120. So instead of getting $6.20, we'll only get $6.10. So that's the only thing on the exam. Be careful of that. Here's the call gain. So where is the covered call gain or loss? Well, in this case, we own the stock, so we do plus the gain or loss on the stock, but then we do minus the call because we sold the call. So if you short something, you sell something, you do minus whatever that gain or loss is. We can put that into here, and so now I'm going to edit this. Come over here and do the covered call. So the stock is the same, that didn't change. What we need to change is the covered call. And that is actually in this column right here. And you're going to see something like, why in the world would anyone ever do that? Why in the world would you ever do a covered call? So you notice at the starting price, or up to 120, or actually up to, we can probably figure this out. So once it hits 120, we shorted the call. So once Apple hits 120, we start losing money. But even if it goes to 122, we're still ahead by $4.10 because the stock goes to 122. So someone gets to buy Apple from us for 120. We have to go out and buy Apple for 122. So we lost $2, but we got $6.10. So at 120, we're long the stock, so we made 120 minus 113.85. But once we hit 120, and that's the most we can make is 116.25. Once we hit 120, the gains on the stock are exactly offset by the losses on the call option. And so once we hit 120, we can't go any higher. Now what's the most we can lose? Or most we can do? The best we can do is we'll make the 615. That's what this top line is, 615. Plus, we made the premium on the stock. So 615 plus the 610. We should, our worst case is we'll make, our highest gain is that we'll make $12.25. When the stock falls, we start losing money. We get to keep the $6.10. That's great, but we're losing money on this stock that we purchased. So let's try an example here. So let's say example stock at $125. So let's try that scenario. Oops. So on the stock, our gain will equal 125 minus 113.85. On the option, here's really important. On an option, it's the same formula. Max of S minus X comma 0 minus the call premium. It's the exact same formula except for we sold the call. All right, so you don't change premium, you don't change formulas. A lot of students get confused. The exact same formula. What's the only difference? Well, it's minus all of that. All right, so you calculate it just like you did before, and that's what I did right here. I calculated just as before. So here, what do we have? So that's going to be equal minus the max of 125 minus 120, comma 0. Well, that's $5 minus $6.10. So that whole thing, $5 minus 610 is minus 110. That's going to equal positive 110, right? Because we're doing the opposite of that. So everything that we would have done if you were long a call option, that gives us negative $1.10. But we put the minus sign there, so we'll make $1.10. So if you take 125 minus 113.85, that's going to be a gain of 1115. So if you take 1115 plus 110, you get 1225, exactly what he did here. And we don't need to try any of the scenarios. $130, $180, $300, $74 million, it doesn't matter. The highest we'll ever be is 1225. So that's the best we can possibly do. We would have been much better off having just bought Apple stock and not done all of this. So some people say, so again, back to the question, why in the world would you ever do this? Here's a situation I would do this. I've actually seen several do this strategy. It makes a lot of sense to me. Let's say you own Apple stock and you have a target price, similar to what you're doing in papers 3 and 4. You're coming up with what you think the stock is worth. So let's say you do an analysis of Apple and you think they're worth 120. You've decided, firmly decided, If Apple hits $120, you're going to sell. If you're adamant that you're going to sell if Apple hits 120, I would say go ahead and sell today, but not by selling Apple stock, but by selling a call option with a strike of 120. You get almost the exact same thing you would have gotten if you had sold at 120. With the stock here, you sold at 120, you would have made 11.15. If the stock kept going up, you would have had all this regret. Boy, I could have just had the stock. But you sold. At least with the covered call, if you do this, you'll be ahead of where you've been if you just sold the stock. Because if you sell the stock, the most you can make is 11.15. Here, if the stock, if you sell the stock, the most you can make is 11.15. If you hold on to the stock and sell the option, if the stock price falls, you won't lose as much money with the covered call as you would if you just owned the stock. If the stock price rises, you would have sold that at 120 anyway. So at least you get that extra $6.10. So it's just kind of the advantage of a covered call. It's about the only time I can think of doing it. And I do know companies that do that. It makes a lot of sense. So anyway, that's a covered call. Covered calls, you can't ask if they're bullish or bearish. They're really neither. You lose money when the stock falls, and you don't make much money when it goes up. So to me, it's really a strategy. You just don't think the stock price is going to move much, or it's going to hit some ceiling and not go above it. And you do this just to enhance. We usually call this it's not a hedge, but income enhancement. So pretty ugly looking strategy, but if you've got a really specific view of the world, it can make a lot of sense. All right, so there's the covered call. Sorry. So the next thing to ask is, what if we don't want to own the stock at all? We just want to buy puts and calls. So the next thing we're going to do is called a straddle or strangle. I actually think strangle is the better term. Straddle or strangle. So this one, we'll have to set this up. So what we do with this, with the straddle or strangle, you're going to buy both the call and the put, but you do not own the stock. All right, so you're long the call, you're long the put, but you do not own the underlying stock. So let's look at this again. Apple, we said, was trading for 113.85. And so what we want to do, we're going to do a strangle, because straddle means you're right at the money. To do a straddle, we'd have to find an option with a strike price of 113.85. We're not going to do this. We're going to buy puts and calls out of the money because we already have them set up. So here we have the call. We use the same call we did before. And here we're buying them, so the ask price is the right number. The higher ask price is the right number. And then on the put, same thing on the put. And bring that over. There's the put. Same maturity. And so now we've got to look at what does this look like. So we'll bring our titles over again. It's going to be a little extra title we've got to do. So Apple stock, if it trades for 70, I'm going to keep these numbers the same. I just don't want to keep messing with them. So the stock gain is the same as before. The ending stock price minus what you paid for it. That's the same thing we've done over and over again. So no big deal there. Bill Gates thinks I need help. Probably do, but not right there, not right with that kind of help. So there we go. Stock price, we've done that 4 times now, 5 times now. The gain on the call, remember this formula, equal max the current price minus the strike, comma 0, which we know that's 0 because the stock price fell, minus what we paid for the option. So there we lose $6.20. The put gain and loss, exactly what we did before. Remember, it's equal max, but this time we start with the strike. That's the only thing you got to remember, and end with the stock, comma 0. We're going to make $30 minus our option premium. We copy that down. So you notice the call loses at most $6.20. At some point, the put starts losing money, but then the call starts making money. And so if you look at this, we're going to combine these two together. So the strangle, gain or loss, well, strangle is nothing more than you own the call, you own the put. So if you're long, you just do plus, right? Plus the call, plus the put. You copy that down. You'll notice in the middle here, this is really strange. In the middle, you lose money. The most you can lose is $9.55. Why is that? Well, that's just your put premium plus your call premium. So you pay $9.55 to set this up. That's the most you can lose. You can't lose any more than that, $9.55. But at the tails, you make a lot of money. So if I do this, it's going to look, I don't know what it's exactly going to look like. It'd be interesting to see. So let's graph the stock first, just so you can see it. Let's put all our stuff in there. So I got to redo all of this. It's the reason I keep copying. So this is Apple stock, and let's add the prices. And again, let's move those down to the bottom. Again, I wish Bill Gates would do that automatically. He comes in wanting to help me, but this is how he could help me, is to make that the default. So there's Apple stock, just like we've seen before. It's just a diagonal line. So what we want to do is add the strangle. It's going to be right here. And you'll see what letter. Kind of looks like a U, maybe, or a check mark. So there's a string. It would keep going up if we went further down. So it is symmetrical on both sides. It is symmetrical. So it's something that loses you a lot of money if the stock price doesn't move. And I don't know why I lost my title. Let's try this again. All right, let me add this in again. Sorry. So we're doing a strangle. And kind of watch what I'm doing again, get some practice. Yeah, I lost my title again. I don't know why I lost my title. But anyway, there's my yeah, I don't know. When Bill Gates eliminates takes away the title, I'm sure there's a way to put it back in there. Chart title, there we go. Boy, thanks Bill Gates. So this is an Apple strangle. It would be a straddle if we did it right at the money. If we did a straddle, you would actually get a V. It would be an exact V. It would come to a point wherever the stock. So the stock was trading for 120. He bought a call option with a strike of 120. He bought a put option with a strike of 120. This thing would come to an exact point right at 120, which would be the sum of the call and put premiums. So here's a strangle. So what is this? This is not a hedge. It's not bearish. It's not bullish. A strangle is a bet on volatility. You're hoping that stock price falls or rises a bunch. You don't really care if it goes up or go down. You just want to go a long way. Because if the stock falls a bunch, you make money. If the stock rises a bunch, you make money. You only lose when the stock does not move very much. So this brings up this book. I recommend this book called Trading on Corporate Earnings News, Profiting from Targeted Short-Term Option Positions. It's a really good book. It's not very long. I don't think it's even 200 pages, if I can remember. Well, 225, but with a appendices. It's very easily written, so it's not a really overly technical book. But what they're doing, and I think I've talked about this book before, and it's not very expensive, only 20 bucks. Compare that to, I don't know why the paperback's $129. But it's you could definitely buy it used if you wanted to. I don't know why one new for $890. I don't understand these numbers. Maybe we should ignore options and get into the book business, because that's bizarre stuff there. But what they're doing is exactly what you did on paper 2. You're talking about corporate earnings. This is a strategy. A straddle or a strangle is a strategy you can incorporate around corporate earnings reports. When they report their earnings, you expect when a firm reports its earnings that its stock price will become much more volatile than it is at other times. And so you can trade on that, and they show you how to do it. It's not so simple to say, well, I'm going to just strangle anytime my company is releasing earnings, because the option market knows that, and so strangles are much more expensive when you do it around an earnings report. So if there's an earnings report before your expiration, then your option, the strangle is going to be much more expensive, because markets just know stocks get real volatile. But what you do, and this book talks about it, is you look at the historical volatility of the stock around earnings announcements, and you're trying to find strangles that are mispriced. There's a friend of mine, sharp guy, he's got a degree in math. He was doing a bunch of these volatility trades. I don't know how he's done since, but the first year he did this, he was averaging 10 basis points a day. And you can multiply that out, 10 basis points times 250 days, that gives you 25% return in a year. And that was his average. And his worst case losses were just really extremely well controlled. And you know what your worst case is going to be on these transactions, because, and that's the nice thing about this transaction, is you know the worst case that you can do, because you bought the options. If you buy the options, the worst you can do is lose your option premium. So I recommend this book. Not only does it talk about this particular strategy, but it gives you the theory of earnings announcements and earnings surprises. This part of the book might be the most important part. So this whole book is not just straddles and strangles. It also tells you a lot of really important stuff about earnings news and earnings announcements. And then they get into the strategy. They don't do the strategy until part 4. So there's 3 parts here that if you read these first 3 parts before you did paper 2, I think it would have really influenced how you did paper 2. So good book. I highly recommend it. I had a friend who's a music teacher, and she posted on Facebook, anybody have any good book ideas? And so I linked this one as a joke, and sure enough, she gave me the laugh out loud. She knew this was not a book she would ever read. So this is the book probably only finance people read, investors read, but it's really not that difficult. I think this is a perfect time for you to get this book over the winter break. It's not a long book, and it brings a lot of what we talked about in this class. And that's the best way to learn finance, is you've seen something in a class, go find something that goes much deeper, and then it just becomes part of your permanent knowledge base. And you'll never have to learn that again. You'll just always know it. So I highly recommend that book. Now this is a long straddle. So what would a short straddle be? With a short straddle, you're not buying the put and the call, you're selling them. So in that case, you'd have to switch to the bid price, not the ask price, the lower number if you're selling. So I'm not going to make that adjustment. But a short strangle would just be minus this, all the way down. So that's one thing I'm hoping you're understanding, is that formula for the call, max of stock price minus strike, comma 0. And on the put, max of strike minus stock price, comma 0. That doesn't change when you're long or short an option. If you're short an option, you do that exact same formula and just put a minus sign in front of the entire thing. So whatever you do, if you're short a strangle, it's just the opposite. So a short strangle would be going upside down. In fact, we could probably even graph that just so you can see just the picture. It's probably pretty easy to guess. Why in the world would you do that? Well, You do this because you don't think the stock's going to move back very much. So a short strangle or a short straddle is you're betting against volatility. It comes back to what we talked about early on in the class about mortgage-backed securities. If you're buying a mortgage-backed security, remember you're selling a call option. You're selling an option. So you hate volatility. So with mortgage-backed securities, you hate volatility because it makes it much more likely the person's going to prepay that mortgage. If rates are real volatile, they drop and people prepay. And so this is what the short call, this is kind of, when you short something, you get this kind of shape. So if you short a call, you lose money as the stock price goes up. If you buy a mortgage-backed security, your call option on interest rates is going to lose you money as bond prices go up and interest rates fall. So now this pattern, I think there's maybe a couple in my class that are taking my life insurance class, and I was showing them the life insurance companies sell something called annuities. And annuities have a lot of options in them. When insurance companies sell annuities, they give their customers a lot of options. And annuities look a lot like a short strangle on interest rates. When interest rates rise, life insurance companies lose because their customers are getting paid these ridiculously low rates, 4 or 5%. And they say, you know what, I'm going to get out of this annuity and go buy a 10% bank CD. So when rates rise, they lose a lot of money. When rates fall, these annuities have these guaranteed minimum rates that they pay, like 3.5%. I've got one annuity as a 3.5% floor, and I love it. It's a low-risk security that I'm making 3.5% on. Yeah, it's wonderful. Wonderful to make that kind of money, tax-deferred. And so the insurance company hates that because when interest rates fall, they've got to keep paying the higher rate, even as their bond portfolio matures, and they've got to reinvest at lower rates. So these last several years when interest rates have been really low, has been devastating for life insurance companies on these products because they have to keep paying 3.5%, even though their own bond portfolios are dropping down to 4, 3.5%, 3%. So they're actually losing money on these. I remember the first time we showed this picture to our CEO, he wasn't familiar with life insurance or annuities, and he was like, are you kidding me? Why would we ever do this? We had to convince him that this section right in here, where you make money, you're making a lot of money. It's very, very profitable, and that's the way annuities are. They're very high returning products, but they're dangerous. So the life insurance industry could be in a lot of trouble if interest rates stay down for a long period of time, or if they rocket up really fast. As long as they stay in a pretty good band, they'll be okay. Now they've been down for quite a while, so life insurance companies are probably struggling on some of these products. But anyway, why do I bring this up? It's because option pricing theory is another thing you can look up in Wikipedia. Is more than just options. It has many, many applications in finance. It has the insurance application, but there's many other applications. A good example, let's do a small company near insolvency. Well, you look at that company, you try to value it. You try to value a Sears or J.C. Penney or Macy's, and you say, this company's probably going out of business. You can't value that stock the way you're doing papers 3 and 4. It just doesn't make any sense. It's probably going out of business. It's probably not worth much at all. So when you have a company like that, the stock price stops being a stock price and it becomes a call premium. Essentially what you're doing is you're buying an out-of-the-money call. If the stock goes out of business, you just lose your premiums. So Macy's, when it was trading for, it's a few dollars, or Sears trading for a few pennies, or General Motors trading for a few pennies, since it becomes a call option. 99% of the time, you're going to lose 100% of your money, but there's a small chance it works out, and then you have this huge gain on the upside. So it looks a stock like that looks a lot like this. You're paying very, very little of it. We talked about penny stocks for a very short time early in the class. Penny stocks tend to be, you have to evaluate penny stocks more like their options than like their stocks. You would never use what you're doing in paper 3 and 4 to value a penny stock. You would actually use option pricing theory to value them. So there's so many applications. I remember on my CFA exam part 2, they gave us a mortgage-backed security. and I had memorized the Black-Scholes option pricing model. So here you have a bond, mortgage-backed security, but I needed option pricing theory in order to explain that bond. So, boy, there's so much. If you like this, boy, this could be your whole career. There's a lot of complexity to it. It's a part of finance that was probably going to be there 100, 200 years from now. 200 years from now. The complexity is such that it's going to scare you to death when you start, but after you do it for a few years, you'll become old hat at it and you'll figure it out. So it's really exciting. Now, what are we going to do? So this is pretty tough stuff. So what I'm going to do is do this all again in the next class. It won't take the entire time, so I'll go about the same speed I have this time, but without all the explanations. And then you'll take that, plus I'm going to do the exam 2 review, so the combination of those two will be about the length of a class. So it's not like I'm going to give you one more class and then you have to also have the exam review as an additional class. But I want to go through this again. The next time I do it, though, I want you to hit pause and you try to build it yourself. Try to get ahead of me, get some practice on doing this.